Hi, class. I hope everyone is having a good week and that the first week of school is treating everyone great. Just wanted to give you guys a little bit of real life element to the class, talk about current events, discuss issues in the mutual fund industry, and really this class should be renamed into more like investment products rather than just mutual funds, because this class now encompasses everything from mutual funds to ETFs to hedge funds. Although there's so many similarities between the groups, we'll focus on mutual funds. But we'll also look at the underlying components of what's going on. I'm sure anyone who follows the market or the news has seen this week about GameStop and what's going on with that stock. It's kind of meteoric rise. And then also we had other issues, well, not so much issues as news updates from major firms. Facebook, Amazon is coming up, I believe, Netflix, Google. And a lot of these firms had great earnings, but were pulled downward because of the GameStop issue. And why was that? How does that happen? Well, a lot of these firms that are short on GameStop have to effectively pay real money to keep that position open. So when GameStop goes up instead of down, they need to generate capital in order to keep their bet on. So what ends up happening is, in order to keep their bet on, if they choose to do so, they have to sell high quality names that are liquid. So what do you sell that's high quality and liquid? Well, you sell your Apple stock to fund your negative position on GameStop, for example, or any one of these other kind of what I call hype stocks, right? These ones that have little fundamentals, but are promoted on TikTok and Twitter and Wall Street Bets, things of that nature. It is interesting to see some of the dynamics going on and how some of the managers might react. There's a great article I posted this week from Barron's, which I highly recommend you guys all get a subscription to that. I don't get any money from that, but I think it's just a great resource for you guys just to get a handle on the markets. And also please feel free to make comments below in the group chat here if you have any questions or curious about anything. So stocks ended lower through the week. Hedge funds were a big part of the squeeze on high quality stocks that otherwise had good earnings. Bubble-like conditions are in some parts of the market. So a lot of times people think about a bubble and they think about 08 and 07 when everything went down. This could be more like a 2001 style bubble where it's just one sector or just one particular group of stocks. For example, in 2001, if you didn't own tech stocks, you left that crisis pretty unharmed. The problem was not people owned tech stocks and they owned a lot of them. You see similar stuff in this market with electric vehicle stocks, anything related to that industry. You could make the case that in some of these gene editing stocks, there's some of that going on. If you guys have heard of CRISPR, Cas9, CRISPR, it's a very popular up and coming technology, but those stocks look expensive here. And of course, like the GameStop and all these other ones that are kind of like hyped on the internet with Virgin Galactic. The list goes on and on. And if you notice, if you lined up a biotech stock like CRISPR, CRSP, against Virgin Galactic, they actually trade and move in a very similar way. One comment I'll make on that is, why would Virgin Galactic and a biotech company, move in the same way? Well, they share, a really important characteristic, and I'll be sharing something next week about like what a factor is and what do I mean by a characteristic. Virgin Galactic and this CRISPR gene editing technology both face this same characteristic and big buildup. But what is it? Is that they don't expect revenue or profits for years, right? Virgin Galactic isn't taking anyone into space anytime soon, and this CRISPR gene editing technology isn't going to be used in a commercial fashion for years. So these stocks that have very little revenue today and no profits today, probably losses, the reason they can trade positive in some of these down markets is because they don't face any of the near-term economic pressure that a company selling in today's market might. Now, stop and think about that for a second. So if you're not selling in this economy, you're selling in some future economy 3, 4, 5 years out. Today's bad numbers don't mean anything. And that could mean, better opportunity for you, right? It could mean you get to take advantage of lower financing costs, right, from today's current environment, but you don't have any of the economic exposure in the near term. So that's just something interesting. Jay Powell runs the Fed, and he just pivoting on topics here. He's been going out in the market crying for lower for longer interest rates, which I believe will happen. Right, we'll have low interest rates for quite a long time. And what impact does that have when you're looking at a mutual fund and an active manager? What they own will tell you what they think about the market. So how I run my portfolio right now, I'm very exposed to areas that benefit from housing, whether it's a home builder. Um, a lot of my clients own Scott's Miracle-Gro. Again, that looks a little expensive here. I don't know if I'd add to it. Other names that might be exposed to the home might even be something like General Mills. They sell pet food as well as cereal. If we're staying home, we're eating less Egg McMuffins and we're having more Cinnamon Toast Crunch. And by the way, everyone adopted a dog, right? So anything related to that, I think is pretty attractive. So I could have an active bet, right? So, but some people could see that same story from Jay Powell and say, like, rates are going up. Doesn't matter what Jay Powell says. I believe something different, right? And that's what makes active managers, different in the market. One other topic I'll mention, and then I'll wrap up this video. I don't want it to be too long. Next week, we'll talk a little bit about ARK Investments, run by Cathie Woods. Comment below if you're familiar with her. She's really been around the industry for years, but has gotten some fame in recent years because some of her active ETFs, which is a new vehicle relatively, have done extremely well. And why is an active ETF, more new than like a passive ETF versus a mutual fund? Well, if you've done the reading and you can start to see the difference, but I'll say it again right here. In ETFs, historically, they're passive, meaning it's just replicating an existing benchmark like the S&P 500. You don't need to be like a Harvard quantitative analyst to do a passive fund. You just need to know how to color in between the lines. Then you have, those are usually come into ETFs. Some mutual funds can be passive as well, but generally speaking, mutual funds are active. One characteristic of mutual funds is they only show their holdings once a month. So everything done in between that month is a secret, because I think back in the day, everyone was like, well, we don't want everyone knowing what we're doing. We're going to keep it secret. It's like our secret recipe. So we don't want to let the market know what we're doing. But recently with ETFs and Cathie Wood's ARK fund, they're just being the opposite, which isn't bad. They're just being super transparent. They're like, when we buy something, we're actually going to let you know, which I think might be a better model. But it also means that, when you buy something and you have some kind of fame, then you have people immediately follow. So does that become a self-fulfilling prophecy? If you have enough clout behind you, maybe. I mean, looping this whole topic together and closing it up here just for comment and conversation. This is what we're seeing with Reddit and Wall Street Bets. Like, how much, we could all agree that GameStop is not probably the company of the future. But what we're seeing here is, a group of investors getting together and bidding up the price of something. I can give you an example where this happened on the opposite, where something I believe, was manipulated on the downside. And that was Care.com. That was a stock I owned for some of my clients. And what ended up happening with Care.com is there was a Wall Street Journal article saying that their background checks were not sufficient on the babysitters. Basically, it had the same flaw of any background check, meaning if you got hired as a babysitter, and then after you got hired and got the background check, you subsequently committed a crime, it wouldn't come up because you already did the background check, right? It's not an ongoing background check. No one does those. But an article was published in the Wall Street Journal just talking about these flaws. The stock crashed 50%, and then some private company bought them for 30% cheaper than it was, a year ago. Sounds like a little bit of manipulation there to me. But these things happen. So it's interesting to see it happen on the positive side. and it's also a good review of, hurting, right? Like so many people were negative on GameStop that even a slight change in that sentiment would have massive make it massively positive. I keep on saying I'm going to make this video short, but I'm just thinking about an investment I made last year in Crocs, and now some of you guys might say Crocs, Mike, that the ugly shoe company. But I just saw momentum, and for Crocs, for you to make money on an investment in Crocs, you don't need Crocs to be the number one shoe company. You need it to go from being the 13th biggest shoe company to the 12th. And if it does that, it doubles in size, and you've doubled your money. So you don't need to be the best shoe. You just need it to be better than it was. So you have to, when you constantly just jump with the crowd, and you're not the first one in, when the first person in makes the most money, you're almost better oftentimes being a contrarian and investing in, what people don't like. One big theme in the market the last few years has been value investors, stocks with high dividends. Those are typically where people go for safety and they outperform in tough markets. Hasn't happened. And why? Is this a structural difference? Is this time different? Which is one of the most dangerous phrases in investing, right? You look at historical data versus today, and you ignore the historical data, and you say, no, this time it's going to be different. So, will value investing end up working? Is another big question. So, I'll leave that there for now, and looking forward to chatting with you guys. I might have a live class or two. I'll notify you guys. Won't be required because I know the structure of the class, but I will just bring that up. So, looking forward to interacting with you guys more.